Hey everyone, I'm Kyla. Welcome back to my channel where I talk about the stock market and the economy amongst other things. Today we're going to be talking about inflation. Yay! I'm moving this week, so go ahead and hit subscribe and drop your best moving tips in the replies because moving is so stressful. But I'm so excited. I'm finally leaving LA. One thing that I'm not stoked about though is inflation. Today we saw an inflation number that was at a 40-year high. So what does that mean? Why is it so high? And what does Powell think about policy moving forward as from his testimony yesterday in front of the Senate? Headline CPI rose 7%. Core CPI rose 5.5%, a little bit higher than expected. This is from the Council of Economic Advisors. Inflation measured by CPI increased 0.5% month over month in December, a deceleration. That's super important, that deceleration point. So things are not increasing as fast as they were, which is positive for maybe one day we won't have mega inflation, but above the average rate in July, August, and September. Price increases were relatively broad-based, meaning that we're seeing price increases across the board. It's not just in energy, it's not just in food, it's everything, which isn't great. But as the CEA points out, the deceleration in headline CPI reflects falling energy prices, so we finally did see a little bit of relief in energy prices, a little bit of relief in gasoline prices, and decelerating food at home inflation, which is really good. That's where consumers really feel the pain, is food and shelter, which shelter did increase. But about half of the year-over-year headline inflation was due to energy and vehicle-related prices. So new cars, used cars, very, very expensive right now. You can see that energy has increased quite a bit, but if you look at that other core inflation, you can see that's remained relatively steady. It really is energy and vehicles that are contributing a lot to CPI inflation. Like I said earlier, headline inflation rose by 7%, the fastest year-over-year increase since 1982. Core inflation rose by 5.5%, the fastest since 1991. Core inflation without food and energy rose 0.6% month over month, about where it was in October and November. So once again, seeing a little bit of deceleration in the increase in prices. Car prices are going through the freaking roof. And then also rent has increased quite a bit. Housing is now contributing more to monthly core CPI inflation than was the typical monthly rate in 2019, reflecting a lot of problems in the housing market. So things are very expensive in housing. The big question is, will we see this continued deceleration? Will we see more acceleration? How are things going to look moving forward? If you dive in a little bit deeper, you can really see that rent has contributed a lot to headline CPI, and you can see that gasoline has contributed a lot to CPI, and then remaining contribution, so that last bar that you see in this top, you can see that all of a sudden these other components are getting a little bit higher. So it really matters the breakdown of contribution. So it's not just like, oh, energy is causing all the increase in CPI. It's like, oh, there are broad-based increases in prices across the board. Headline CPI came in as expected. Core CPI came in a little bit hotter than expected, but stocks were like, okay, we know that inflation is going to be high. Things remained relatively calm after the news, so no big freak out from the market because everybody's kind of expecting this. Growth stocks have already gone through quite a bit of a rout with rising treasury yields, and the Fed coming out is pretty hawkish. And so a lot of this stuff is beginning to get priced in as everyone's like, okay, we do see higher inflation. We know that the Fed is probably going to respond. Let's talk about some inflation drivers. So this is a really good graph from Jason Furman, where inflation is mostly driven by durable goods and not services. As supply chains normalize, we will see durable goods normalize, but what happens to services will be a little bit different. That is where you could see this labor wage problem really come out because labor markets are pretty tight. We just saw an unemployment print that was below 4%. You just have a lot of people not going back to work. You have a lot of retirees choosing not to join the workforce again, and that creates a whole lot of problems in terms of a normal workforce. And one of the things that Powell said in his testimony was that he thinks that we're getting closer to maximum employment and that inflation will hurt maximum employment. So if prices get too high, people are going to stop hiring. They're not going to be able to pay wages as much because things cost so much money. So he was like, it's really important that we solve inflation in order to achieve our dual mandate of maximum employment. And you can see in this graph, services less energy CPI inflation, that services have ticked up quite a bit over the past 3 months versus the previous 12-month and 24-month timeframes. Then looking at energy, so energy has definitely been the biggest driver of inflation. It went down, it's decelerated, but the big question is, will it stay down? Natural gas has gone up again because we're expecting colder weather. That'll be really interesting to watch to see how energy markets recover. I think energy is super important and we don't realize it sometimes. That is definitely something to keep an eye on moving forward, but we did see a deceleration in energy this time around. However, shelter, we did not see a deceleration in. It's very high. Rent is one of the core drivers of inflation. The CPI uses two different rent metrics. One is owner's equivalent rent, which basically, like I said, goes and asks homeowners on what they would be willing to rent their house out for, which is maybe not the most perfect way to do something. Then rent itself is just a real number, but it's sometimes a little bit harder to get. Jay Parsons has a really good thread on it where it's not a perfect calculation because everything is constantly moving. Just because asking rents for a new lease are up 14%, that does not mean the average renter paid 14% more this year versus last year. Rent itself is a little bit of a confusing number, and this graph, what's the rent and how does it factor into inflation, shows all these different flavors of rent that you can consider. Jay Parsons says that rent's actual impact on inflation is somewhere between in-place rent and owner's equivalent rent. So if you look at that graph, it's that thick blue line and that red line. That's basically saying that rent is somewhere between 4 and 6% inflation. So it's a little bit confusing. It's a little bit hard to actually get a good number on rent. Fitch came out today and they said that US home prices are expecting to slow, that they're not expecting that much growth, between 5 to 7% in home prices. So that could put downward pressure on rent prices. Home prices oftentimes move before rent. So we will see how all of that plays out. I have a whole video on housing prices. So if you want to go check that out, that'll have a little bit more information on. And then used cars prices. So this has been the big one. This is 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 kind of a proxy for a lot of different stuff. Semiconductors, consumer demand, how good people are feeling. And used car prices continue to rise in December. They were up 37% last year. New car prices up nearly 12%. And that contributes a lot to this inflation number. They just basically have gone way up because people want a car. Semiconductor problems are making it hard for new cars. Everyone's like, I'll get a used car, and supply and demand. So it's a little bit tough on that one, but that has driven a lot of inflation. And then, of course, geographical inflation. So prices vary across the country. Prices in Atlanta rose 9.8% compared to a year ago. Phoenix, 9.7%. And you can see that that is pretty hot. There's a lot of inflation in the South and the Southwest. So New York, only 4.4%. San Francisco, 4.2%. So it does impact, obviously, different parts of the country differently. Obviously, like this is an aggregate number. Oranges and tangerines are up, I think, 8%. Yeah. It's weird how all these different things happen. With oranges, it's, farmers probably haven't been able to produce as much. Maybe weather hasn't been good. And so there's all these different variables that impact prices. And it's really hard for the Fed, speaking of the Fed, for the Fed to come in and just say, okay, we're going to raise rates and that's going to stop inflation, because the Fed has pointed out now that this is supply side inflation. And so all you can really do is temper consumer demand by raising rates and be like, hey, stop spending so much money out there. That's not always easy to get consumers to listen. And bond markets are now pricing in a 90% probability that the Fed will raise rates 4 times in 2022. Today's inflation data will make the Fed kind of good to go. Like if today's inflation data had come in at like 5%, everyone would be like, well, maybe we don't need rate hikes. But now it's kind of like, okay, it's time to roll. So a member of the Fed called Mester, who is a voting member, says that for inflation to ebb, it's key for the Fed to take action. The case is very compelling that we remove accommodation. Depending on what happens in the economy, some of the rate increases may need to be moved forward. So you just see members of the Fed who are voting on different policy decisions becoming a little bit more hawkish. They're saying that this is not just pandemic inflation anymore. This is something bigger. There's supply chains and wages that are pushing up inflation. So we just got to raise rates, shrink our balance sheet faster. And so you do see people becoming a little bit more hawkish. The head of the Atlanta Fed, who is not a voting member, says that the Fed should reduce its holdings by at least $100 billion a month, which is pretty aggressive to say the least. So that would be them doing quantitative tightening, because they would have to sell in order to reduce by $100 billion a month. Runoff for the balance sheet is normally around $40 billion a month. But essentially what the head of the Atlanta Fed is saying here is that you would allow more securities to mature every month, and that would imply a little bit higher of a runoff, about $60 billion. But still, you would have to probably sell about $40 billion in order for this to work. You see people saying it's time. And Bill Dudley, who is a former member of the Fed, was like, the Fed's going to have to really move fast on this stuff, and they're behind the curve. And also, speaking of the Fed Vice Chair Richard is going to be stepping down because it looked like he did some pretty suspicious trading. The central bank has a lot of different things to answer to. They have to answer to inflation, they have to answer to the jobs market, and now Powell has to protect the credibility of the bank, because you've got people who were probably trading on insider information, and it looks very bad. The Fed has to get a little bit more credibility, and right now they just don't have that to a certain extent. And like I talked about in my narratives video yesterday, if the Fed doesn't have credibility, none of this works. Then the other question is, well, how will crypto react? Brazil, El Salvador are adopting it, which could push more people to do the same as some sort of inflation hedge. But like I talked about yesterday, we'll see. Powell did say yesterday that the Fed is releasing their CBDC paper, which will be super interesting. And he also said that stablecoins and the CBDC could exist simultaneously. So we'll see about that. Then with regards to the labor market, so the Fed has that dual mandate of price stability and maximum employment. The labor market is super weird, but like Powell said yesterday, he thinks that they're close to maximum employment, and he's worried that the labor force is not causing inflation, but it could one day. So if they got to take care of inflation now, and then that could help them manage maximum employment down the road. So some final thoughts. A lot of people are expecting inflation to slow this year. Will it get down to where the Fed thinks that it will, around 2%? No, probably not. But developments in the labor force are allowing the Fed to do what they think they should do. High inflation is also a threat to maximum employment, according to Powell. So they really just need to take care of inflation, and that will solve an element of the labor market, seems to be their theory. And they also have to become a little bit more credible. And he also called the debt unsustainable. So I think he's a little bit fed up. Oh my gosh, that's so good. The Fed is fed up. So we'll see what they end up doing, but we could get 4 rate hikes this year, but they will probably lift off in March. Inflation is a political issue too. Powell is very sensitive to that. You saw it yesterday during the testimony, and he does think that we're going to return to normal, but they will raise interest rates if they have to. So the Fed is doing. Some other questions: supply side issues, does that get solved by raising rates? No. Will it be fixed if they raise rates? No. Will it make it worse? Who knows? Can monetary policy help durable goods? Can consumers stop spending? Maybe. The Fed can influence the demand side, but can they? How do you address the logistics of this, and how much more inflation will we see? People are expecting things to decelerate, but will it? Will it? It looks like it is, but we will. We'll see. So that is kind of what's going on with CPI, going on with the Fed, and I hope that you're doing good. Like I said, like, comment, share, subscribe, give me advice for moving. I don't own a lot of things. If you have been following the channel for a long time, you'll remember that I don't own furniture, so it won't be that bad of a move, but it's so stressful, the logistics of it. I'm having my own supply chain issues. Anyway, I'll see you all soon, and bye.